Hello, everybody, and welcome back. Today, I'm joined by Justin Kariya, Head of Economic and Market Strategy at City of London Investment Management. We will discuss the outlook for emerging markets in 2026, from the US dollar and earnings momentum to AI-related investments, geopolitics, energy price risks, and country-level dispersion. Justin, thank you very much for joining us today.
Thank you for having me.
Justin, after a very strong year for emerging markets in 2025 and the recent geopolitical shock around the Middle East, where do you think emerging market equities stand today? Closer to the beginning of a broader re-rating or already largely priced in?
Well, I mean, EM has had a very strong run this year and also last year. I mean, naturally, kind of investors sort of question, exactly as you're asking, whether or not we're kind of early, mid, or late cycle. And I think it's very easy after kind of such strong gains to kind of come to the conclusion that maybe the best returns are behind us. But I would just point out that a lot of the rally that we've seen over the past year is driven by earnings growth. Actually, if you look at the forward P multiples, they've actually derated in emerging markets, or at least relative to ACWI. So if you dig a little bit further into that, if you look at consensus earnings projections for emerging markets relative to other major economies or stock indices, rather, EM earnings growth is still very strong and higher than the rest of the world over the next year. And it's still trading at a very low forward PE. So I guess the kind of main takeaway from that is if EM or emerging markets rather continue to produce relatively robust earnings growth beyond this year, then there's certainly scope for the market to re-rate.
As you mentioned, emerging markets still trade at a significant valuation discount to developed markets, even though earnings expectations have improved. Why is the discount still there? And what needs to happen for investors to assign a higher multiple to emerging markets equities?
So, I mean, first thing I would point out, for particularly younger, I mean, I'm not that old, but if you're under the age of maybe 40, you probably don't remember that EM used to trade at very similar kind of valuations to other developed markets and the US. If you look kind of prior to 2013. I think it's a very good question in terms of why that sort of discount has been very persistent, over the past 15 years or so. And I guess, I mean, there's probably various kind of explanations, but I guess the kind of ones that come front of mind for me is first, I mean, I think there's general kind of frustration from asset allocators and investors, just from long periods of underperformance in emerging markets over that kind of 2011, 2024 period, particularly relative to the US, if you're a US allocator. And kind of on that point, just to dig into that, I mean, US returns have obviously been very strong relative to international stocks kind of more broadly, not just EM. So I think it's kind of natural for US investors to think, why would I look elsewhere in my portfolio, when you've had such strong returns in the Meg 7, for example, or the FANGs before the Meg 7. And I guess maybe kind of one thing is to add to that is, well, certainly, I mean, EM earnings have improved, as I kind of mentioned previously. So that's kind of making the investment case a bit more compelling. But I think there's still a bit of skepticism about the sort of sustainability of that earnings growth from emerging markets. A lot of it is driven by artificial intelligence or more recently. And, it's very difficult, I think, for a lot of investors who aren't necessarily tech experts to how do you forecast, AI sort of demand in the future and the sort of potential, opportunities that exist from that. And also, the dollar trend is also quite important for emerging markets. And kind of, as I mentioned, kind of for people's age, I mean, most people's careers have been dominated by a much stronger sort of US dollar. So, if we're in a period of dollar weakness, sort of how do you sort of shift your mindset and kind of what does that imply for emerging markets?
So this leads directly into the next question. So the US dollar has been one of the most important variables for emerging markets for many years. So what is your base case for the dollar from here? And which emerging markets regions would benefit most if dollar weakness continues?
So, I mean, first out of the gate, I'll just sort of say that, our kind of house view is that we expect the US dollar will be more likely to weaken over the course of the year. And, historically, that has been a major tailwind for emerging markets,
Mm,
just given it does tend to have a strong negative correlation to
mm,
the US dollar over a very kind of long history of time for various reasons. I think one sort of pushback to that is people will point out the dollar is the world reserve currency and will probably remain
mm,
so over the foreseeable future. And I 100% agree with that statement. I think there is kind of a lack of kind of alternatives to really dethrone the dollar from that status. But I would also point out that that doesn't exclude the possibility that you can have periods of material dollar depreciation, even as it is the world reserve currency. You can look at the kind of early 2000s. I mean, the dollar had double digit depreciation in trade weighted terms, and it was still kind of the world reserve currency. That was kind of peak US hegemony. So, you can still have periods of dollar weakness, kind of even with, it being the world reserve currency. And, we think that's really a combination of, valuation, cyclical, structural factors. So, the dollar still looks expensive on kind of many valuation metrics. So not a great starting point if you're a buyer of
mm,
dollars. Typically, people look at real rate differentials as kind of a metric to kind of look at where the dollar trend's heading. And we would just note that when we plot U.S. real rates relative to other major economies, it does look like the trend is lower for the U.S. dollar. And maybe just a kind of third point on the structural story. We do think there is going to be greater demand for diversification from U.S. dollars,
mm.
particularly as we move into this kind of more multipolar world. And actually, maybe just a fourth point, I would just add, kind of more short term that, I mean, the dollar did briefly rally in March as we were kind of at peak sort of war fears, but it's since reversed. And I think that's quite interesting. It maybe suggests that it's potentially a less sort of reliable safe haven than it's been historically. So I think there is a good case that the dollar can potentially weaken from here. I guess you asked which markets would benefit from that. I would maybe just reframe that question slightly and look at maybe which emerging markets benefit less, because I think as a kind of asset class, EM does tend to kind of broadly sort of benefit from a weaker dollar
Mm.
environment. But I would just note, when we look at sort of our country allocations, a lot of the Gulf countries or GCC countries are managed or pegged against the US dollar. So they do tend to underperform in weaker dollar environments relative to other
Mm.
emerging markets.
Makes sense. You already mentioned the magic AI word. So AI is often discussed as a US technology story, but actually much of the hardware supply chain sits in emerging Asia. So is AI capex now becoming a genuine emerging markets macro theme?
Yeah, I definitely think that as an EM investor, you really cannot ignore what's going on with the capex trends in the US, particularly from these US hyperscalers. This is probably or arguably the biggest tailwind for EM right now is just that kind of big spending from US hyperscalers. They're spending hundreds of billions on semiconductors, chips, maybe that will be trillions at some point on a kind of annualized basis. And they really seem kind of insensitive to kind of energy costs or other macro factors for various reasons. They have their kind of reasons for making these large investments, trying to defend their moats and kind of being at the leading edge of kind of AI. And I guess the kind of takeaway for EM investors is this is really direct revenue in the pockets of kind of some key EM markets in the technology space, particularly technology manufacturing, rather, particularly South Korea and Taiwan kind of stand out as kind of two markets that have been big beneficiaries of that. And even as we've seen over $100 oil prices in recent months, these kind of markets in that EM tech related space have continued to outperform, driven by kind of strong earnings growth and expectations, as I was highlighting earlier.
So you already mentioned the concentration there in South Korea and Taiwan, who remain central beneficiaries of the AI hardware cycle. So how do you balance strong earnings momentum in semiconductors and memory chips against valuation risks, geopolitical risks, and the concentration of emerging markets performance in a small number of companies?
So, yeah, I mean, I think you've rightly pointed out. I mean, there are kind of risks that, I mean, so first of all, I mean, there's a risk that the party won't sort of last forever in terms of this kind of demand for AI, and it will eventually end at some point in time. And there's also this kind of concentration risk, which is something that US investors have had to deal with. So all of these things create challenges. I guess the way kind of we would look at it is, first of all, I don't think investors can ignore sort of the strength and just decide, I don't want to sort of invest in that area,
Mhm.
just given the sort of strength that some of these companies or revenues that some of these companies are generating, just given how essential they are for the global supply chain and artificial intelligence. And that demand may persist for years. It's not necessarily something that might, end tomorrow. It could, but that's I don't we're not necessarily looking at that, and the capex sort of numbers are still coming in relatively strong. I think a way a good kind of EM portfolio manager should kind of manage some of these risks and also kind of take advantage of the opportunities here is trying to keep some exposure in some of these kind of key areas, growth areas, but also thinking about kind of where the next kind of opportunities are and kind of building also some exposure for the kind of next thing that's going to come, whether it's EM or in kind of a global portfolio. So we look at, commodities will potentially become more important just in terms of building energy infrastructure. So certainly EM offers some exposure in that area. And also, right now we're in this kind of picks and shovels phase of AI where you're kind of training models and, building the hardware. But also the kind of the next step is going to be the application of AI. How are we going to use this sort of kind of technology? And so, areas such as robotics, defense and military spending, AI agents for productivity and kind of whatever sector those might be sort of used are going to be sort of very important. And EM also does offer kind of some exposure in that area, particularly I'd say in China as a kind of a potential investment area.
China is a great keyword. So China remains one of the most debated markets in EM. So you differentiate between China A shares and offshore Chinese equities. What is the case for that distinction, and what would need to change for you to become more constructive on offshore China?
Since 2021, I think it was. I mean, China has been a pretty
Mm.
unloved market by foreign investors, and we certainly think there's potential in caution. We're kind of cautiously optimistic about the market, and there is a risk, I think, when investors sort of kind of blanket avoid a market that they are going to potentially miss out on opportunities, even though there certainly are sort of risks associated with it. So just maybe some examples in terms of kind of areas of growth in China that are interesting. So renewable energy, which was out of fashion maybe 3 months ago, but now I guess we should start thinking about energy diversification. I mean, that's suddenly becoming an investment theme, and China is kind of the leader in that area. I was kind of mentioning the kind of application of AI. So, China certainly is kind of at the forefront of robotics. And also there are kind of large language models, maybe a cheaper price point than some of the ones in the US. So potentially, they have some advantages there. Kind of, again, kind of linking to renewables, also electric vehicles suddenly are becoming fashionable again. As 3 months ago, it seemed like, that sort of trend was ending. But, certainly China is at the forefront of that area. So just kind of, I'm not, I'm just making the case that, there are kind of potential areas where China could become very interesting and sort of capture some kind of important investment themes as a kind of leader or competitor to the US in the future. I guess, there's clear geopolitical risks associated with China, which is maybe one reason why, investors have avoided the market. It's not a secret that US government and Western governments, I'd say more broadly, kind of turned kind of hot and cold on China at kind of various points. So that's kind of one reason why we've tended to prefer the A shares, given that they're mostly domestically owned. So they have maybe less risk of foreign outflows, just given that kind of large domestic investor base. I would also add kind of we're also seeing evidence that policymakers in China are trying to shift a large pool of savings, domestic savings, into kind of the equity market, we think. And so potentially the A shares will be a beneficiary of that. But in terms of, what would sort of change our kind of view to maybe look at the offshore stocks, I would just note that, I think if US-China relations maybe improve, that, that could certainly be a kind of important trigger for the offshore stocks.
The Strait of Hormuz situation has brought energy dependency back into focus. So how do you assess the impact of higher oil prices across emerging markets? So both in terms of countries that are vulnerable and those that could eventually benefit from energy supply diversification.
Yeah, I mean that's certainly the kind of the main topic on people's minds. So I would just say, kind of first and foremost, one thing that we really try to focus on are the key themes and not get too bogged down into short-term noise. And so going back to this AI theme, I think this is kind of a key sort of investment theme that's going to, certainly be important over the next 3 to 5 years, maybe longer. Even throughout this sort of conflict and this oil shock, we've stayed very focused on kind of identifying kind of which areas of emerging markets in the tech space, would be potential beneficiaries of that trend. And so far, that's served relatively well. As I mentioned, some of those names have done relatively well, even with the oil prices that we've seen. But having said that, we also do need to focus on, certainly an important kind of macro risk that the Strait of Hormuz is closed. Oil prices are higher. That's certainly not a small shock by any means. So we do try to identify countries that are most vulnerable from higher oil prices and maybe lack a good sort of structural growth driver, or maybe lacks the sort of buffers to kind of withstand or kind of work through those shocks. So that certainly does influence our allocation decisions. And maybe just kind of the beyond the short-term volatility in oil, because while it may go higher, it also may go lower. I think maybe just an important theme, kind of regardless of where oil prices are in a month from now, is just energy diversification and trying to secure, choke points for various countries. So Latin America, I think, is a potentially interesting area just because it's become maybe more geopolitically secure as a source of commodities, given its closeness to the US. I just mentioned Chinese renewables, those could potentially become more valuable. Also, Korea is home to some very important battery manufacturers. So I think, there's potentially some opportunities within here to take advantage of following the shock that we've had, and also previous shock, with the conflict in Russia, Ukraine.
Global trade is being reconfigured. So with Mexico, Vietnam, and parts of the ASEAN countries gaining from supply chain diversification. So how durable is this friendshoring trend? I remember also this China plus one supply chain strategy. And what are the key risks from tariffs and eventually renewed trade tensions for emerging markets?
Yep. I mean, our kind of view is that we think this friendshoring or supply chain readjustment, it's an important long-term theme. And we think that, it's certainly important for some particular emerging markets areas such as, Mexico or Vietnam, just to name a few. And, I think the real driver of what's going on here is just the US desire to reduce trade exposure to China, just given how economically integrated, the US and China have been historically, and they've maybe been trying to diversify kind of that economic linkage. So as that process has progressed, which I would say really kind of started, in Trump's first term in 2016, there's been some clear kind of beneficiaries of that, which we, think can potentially continue. So Vietnam is kind of one area that we've highlighted in our allocations. US politics can shift, tariff policies can shift. This is maybe a longer term theme that we see as kind of progressing over time rather than kind of a 1 week sort of trading theme. But ultimately, I think the kind of core thing to focus on is that the US does want to reduce economic exposure to China. Maybe not completely, but certainly kind of manage that. And the US still requires, I think, cheap manufactured goods.
Let's look at the other side of the world. So Latin America's political map has shifted meaningfully in recent years, with several countries moving toward more market-friendly agendas. Does this change the structural case for the region? And how do we differentiate between Mexico, Chile, and Brazil?
Yeah, I mean, as your question sort of highlights, I mean, several countries have had elections and have moved closer, I think, or are kind of potentially going to be moving closer in their relationship with the US. So, I mean, that, potentially has, I think we think many kind of benefits for some of these countries, just in terms of maybe particular economic advantages, kind of having that closeness to the United States. And also, that closeness or geographical closeness, I think, creates some geopolitical security. So as kind of people are thinking about kind of, where to source maybe commodities from, without kind of having to worry about these kind of choke points or geopolitical tensions manifest themselves. Certainly Latin America provides a very compelling case in that department. At the moment, we think Mexico is a really interesting area. It has a very kind of pragmatic, I think, leader in terms of what she's demonstrated so far in terms of dealing with this sort of volatility in U.S. politics. And we're also seeing kind of relatively strong earnings growth from Mexico, I think, which is certainly encouraging for that market. Brazil, I mean, is an area where we've been, I would say, a bit more kind of cautious ahead of kind of the upcoming election, which I believe is in October. And they've also suffered from relatively high debt levels, which is kind of an area that's just really sort of we've been focused on. But I would say that over kind of recent months, the investment case for Brazil has also improved, just as kind of a key commodity exporter, and again, kind of in a more sort of geopolitically secure area.
Looking into the second half of 2026, so what are the 2 or 3 macro indicators you're watching most closely? And how should institutional investors think about the role of an actively managed emerging market strategy in a broader portfolio?
I think, the kind of the key themes to focus on, is really kind of, as I've mentioned AI many times, but I mean, it's just, it's really hard to ignore because it is really kind of the main driver of kind of markets in recent years. And we think that will be kind of a really important thing, both in terms of its strength and potential, areas where that trend might slow at certain points in time. Kind of a second thing is, I think the dollar trend is going to be kind of very important, as I kind of mentioned earlier in our discussion, that most people's careers have been in a very strong dollar period. So I think it's kind of important just to kind of watch for potentially that trend shifting meaningfully, as we think it already has, but it's still kind of a source of debate. And maybe just a third one, I think, in terms of kind of macro things to focus on is maybe commodities becoming a more sort of important or prominent kind of investment theme, beyond just gold. I mean, gold has certainly been top of people's minds, but kind of the broader set of commodities, particularly, with what's been going on in geopolitics and kind of energy diversification, I think becoming a more important theme. I guess the second part of your question, the role of active managers in EM. I mean, I would just kind of highlight that. I mean, the nature of investing in emerging markets is the attraction of emerging markets is there's really kind of great opportunities to invest there, but equally, there are always going to be kind of bad apples. There's badly managed economies. There are risks associated with it. So I think, the advantage of active managers, if you can identify the good ones, and, I'm obviously biased, but we try to be sort of a good one, but is to try to kind of gain exposure to kind of those high growth areas while kind of limiting the sort of downside risks from some of the kind of maybe problem childs within emerging markets. So, our sort of framework has always been to stick to a disciplined process and try to identify opportunities for returns for our clients and repeat that process.
This was Justin Kariya, Head of Economic and Market Strategy at City of London Investment Management. Justin, thank you very much for being with us today, sharing your thoughts and insights with us.
Thank you.